Techniques of managerial control. We have learnt that a manager needs to perform controlling function to check if the organization is performing as per the set goals. There are various control techniques that provide a manager with the type and amount of information he needs to measure and monitor the performance of his employees. These control techniques may be broadly classified into two categories: traditional control techniques, advanced control techniques. Traditional control techniques are those which are being used by managers for a long time now. Traditional control techniques include personal observation, statistical reports, break-even analysis, budgetary control. Personal observation is the most traditional method of controlling. This method enables a manager to observe the operations at workplace. Through this technique, a manager corrects the operations on the spot and directs a worker if the latter is not performing the work according to the set standards. The employees feel psychological pressure and they perform well as they know that they are being personally observed on their job. The technique is very time-consuming and not suitable for all kinds of jobs. A manager may use statistical reports analysis in the form of averages, percentages, ratios, correlation, etc. to collect useful information regarding the performance of an organization in various areas. Such information in the form of table, graphs, etc. enables a manager to compare performance of an organization in current period with that in previous periods. A manager may use break-even analysis to analyze the relationship between cost of production, volume of production, price level of output and profits. Through this technique, a manager can estimate profits at different levels of activities. A point where total revenue of an organization is equal to its total cost is break-even point. It is a no profit and no loss point. In the given figure, break-even point is determined by the intersection of total revenue and total cost curves. As we can see in the given example, the firm will break even at 450,000 units of output. It is beyond this point that the firm will start earning profits. Break-even point can be calculated by the following formula. Break-even point is equal to fixed costs divided by the difference between selling price per unit and variable cost per unit. A budget is a numerical statement expressing plans, policies and goals of an organization for a definite future period. Budgetary control is a system wherein budgets for different activities are used for controlling and planning purposes in an organization. This technique enables a manager to compare actual performance with a budgeted performance after the completion of a particular activity. If there is any negative deviation, he needs to take necessary actions to achieve organizational goals. The most common types of budgets used by an organization are sales budget, production budget, material budget, cash budget, capital budget, and research and development budget. Advanced control techniques are those which are of recent origin and are comparatively new in management literature. Advanced control techniques include return on investment, ratio analysis, responsibility accounting, management audit, PERT and CPM, management information system. Return on investment or ROI is regarded as a useful technique of control. It determines the rate of profitability on the capital employed. Hence, it is also known as return on capital employed. Return on investment or ROI can be calculated as under. ROI is equal to net income or profit divided by total investment. A manager can use ROI to measure overall performance of an organization or of its individual departments or divisions. Ratio analysis. A manager may compute ratios to analyze financial statements. The most commonly used ratios can be classified in the following categories. 1. Liquidity ratios. 2. Solvency ratios. 3. Profitability ratios. 4. Turnover ratios. A manager needs to calculate liquidity ratios to determine short-term solvency of business. Through the analysis of current position of liquid funds, he can determine the ability of an organization to pay the amount due to its stakeholders. Examples of some liquidity ratios commonly used by managers are current ratio, quick ratio, etc. A manager needs to calculate solvency ratios to determine the financial soundness of an organization and how well the company can satisfy its short and long-term obligations. Examples of some solvency ratios commonly used by managers are debt-equity ratio, proprietary ratio, interest coverage ratio, etc. A manager needs to calculate profitability ratios to analyze the profitability position of a business. These ratios analyze profits in relation to sales of funds or capital employed. Examples of some profitability ratios commonly used by managers are gross profit ratio, net profit ratio, return on capital employed. A manager may calculate turnover ratios to determine the efficiency of operations based on effective utilization of resources. Higher turnover means better utilization of resources. Examples of some turnover ratios commonly used by managers are inventory turnover ratio, stock turnover ratio, debtors turnover ratio, etc. Responsibility accounting is a system of accounting in which different sections, divisions and departments of an organization are set up as responsibility centers. The head of the center is responsible for achieving the targets set for his center. Responsibility centers may be of the following types: cost center, revenue center, profit center, investment center. In a cost or expense center, a manager is held responsible for the cost incurred in the center. For example, in a manufacturing organization, production department is classified as cost center. In a revenue center, a manager is primarily responsible for generating revenue. For example, marketing department of an organization may be classified as a revenue center. In a profit center, a manager is responsible for both revenues and costs. For example, repair and maintenance department of an organization may be treated as a profit center if it is allowed to build other production departments for the services provided to them. In an investment center, a manager is responsible not only for profits but also for investments made in the center in the form of assets. Traditional control techniques fail to appraise the quality of managerial personnel, which is essential for the success of an organization. Management audit is a step in this direction. Management audit refers to systematic appraisal of the overall performance of the management of an organization. It can be performed by outside consultants or by an organization's own internal audit staff. Management audit locates the deficiencies in the performance of management functions such as planning, organizing, staffing, directing, and control, and suggests possible improvements. Network analysis is the general name given to certain specific techniques which help a manager to plan, schedule, monitor, and control large and complex projects. Two different techniques for network analysis are PERT, Program Evaluation and Review Technique, and CPM, Critical Path Management. Program Evaluation and Review Technique, or PERT, was developed in 1958 by Booz Allen and Hamilton under the sponsorship of the US Navy for use in Polaris submarine project. Around the same time in US, Critical Path Method, or CPM, was created by DuPont with the help of Remington Rand. A manager may use PERT and CPM to deal with time scheduling and resource allocation for a variety of complex, diverse, and interrelated activities. These techniques aims at effective execution of projects within given time schedule and structure of costs. Under these techniques, a manager needs to divide a project into a number of clearly identifiable activities or tasks. Then, he will have to prepare a network diagram to show the sequence of activities, the starting point, and the termination point of the project. After this, he needs to assign time and/or cost estimates to each activity. Then, he will have to compute the longest time path through the network. The path is known as the critical path. At last, he may modify the plan to control the execution and timely completion of project. PERT and CPM are used extensively in areas like shipbuilding, construction projects, aircraft manufacture, to name a few. Management Information System, or MIS, is basically concerned with processing data into information which is then communicated to all levels of personnel and departments in an organization for appropriate decision-making. It provides the right type of data and information to the top management at the right time so that they can formulate appropriate control techniques in case of deviations from standards. In a nutshell, managerial control techniques help in measuring the overall efficiency of management from different perspectives to suit various conditions and requirements. Control techniques provide managers with the type and amount of information they need to measure and monitor performance. The information from various controls must be tailored to a specific management level, department, unit, or operation.